one. How you doing, Rick?
I'm doing good. It's Tuesday. It feels like Monday. Funny how that works.
I know
out.
it's Monday and Tuesday all rolled into one. Aren't we lucky?
I know. It's just pretty cool.
Well, I've got a hot topic to discuss with you today, and I've been working on a way to articulate it for some time. And I think today's going to be the day. I'm just irritated enough that I'm feeling like I'm going to bring this to the surface. So I just want to talk about, in general, just a teeny tiny bit of history, because I know everybody loves history. And that is that ever since people have been making money off of buying and selling houses, there's been people that want to make more money off of buying and selling houses. So when I got into the business in the 90s, that meant, discount brokerages. Well, that just wasn't enough. People wanted more. And so in the 2000s here, not too very long ago, we started the iBuyer. That has been an option for sellers that want more and don't want to do anything and are looking at making, a cash deal and keeping their life simple. But what they didn't realize in 2017, that wasn't such a great option for them because they had to pay all the closing costs and that sort of thing.
Right.
So it's sort of evolved. And even before that, there was the 1% home seller, which is still around. I mean, there's a lot of ways and a lot of different companies that have just tried to come in and disrupt the market, and they just haven't been successful because real estate is really, like we talked about, it's just a brick and mortar business. And as much as we try to make it technology, it's people to people. And so the thing that I'm super irritated about today is that I want to share just a little story. I had this couple that they're retiring. And so they were moving from a 2-story house to a 1-story house last year. And there was a fellow in a neighborhood that they were familiar with. It was a really small condo association. There were probably 50 units or less in there, and they were all pretty similar in size. So that's, a dead ringer for easy to figure out what something is, valued at. And so there was a fellow in there that wanted to sell. And so we approached him and we wrote him a really nice and generous offer based on the fact that we had 3 other sales in the area. And while he was kind of fishing for offers from us, he was also fishing for offers from an iBuyer. So our offer was $650. And the end of the story is that he sold it to Zillow's program for, our offer was $650. He sold it to them for $725. And that did not make any sense at all whatsoever. Why in the hell would Zillow pay $75,000 over the going market rate, considering that they're going to have costs, cost to carry, cost to resell, cost to cure, the whole thing. And now it just took that house right off the market to a regular home seller. And this has been happening all over the country. Big corporations are coming in and trying to buy up housing, and they're failing. They're failing because
hugely failing.
Yeah, you can't, you just, it's definitely big enough to fail. And there's been some numbers that have come out. Now, just to kind of review, this is an article from Housing Wire from a gentleman named Matthew Blake, and it is from today. Today's the 31st, right? This is what really fueled my conversation today because I'm just tired of it. So in this article, he states that like Redfin has a program where they'll buy your house. Well, they lost millions and millions of dollars, even here in the first quarter. And their stock has gone from $22 a share in 2017 to $76 a share last February. But today it's $9 a share. Okay. And a lot of this.
Yeah. Go ahead.
a lot of this has to do with their home buying. This is not for the faint of heart. If you're buying and selling and basing things off of your Zestimate, you might be up the creek a little bit. Then let me see here. Here's another
Oh,
red.
by the way, Zillow, I mean, Redfin lost $91 million in the first quarter of this year.
Right, exactly. When is this? Oh, this is from Saturday. This is another Redfin's tank stocks tank, sorry.
Mhm.
And then this is the article from last year, from November, that talks about Zillow leaving the house buying business. They lost $328 million that was all tied to instant buying or the iBuying unit.
Mhm.
So what I'm saying is this, is that I really think that these big corporations buying up tons of houses, I mean, they lost $328 million. Like, how many houses did they buy? You know, and many houses did they overpay for? And now that's the new comp for, you know, our regular buyers that are trying to buy with, you know, a down payment that even at 5% of 700,000, you know, it's like people are scraping their money together trying to buy a house. And I think that corporations getting involved in the housing market is something to really, really think a couple of times about, because I don't know, you know, I'm all into free markets and opportunities, but like here in Anaheim, I'll tell you something that happened. We had a lot of short-term rental housing, right? So there was a group that met with me that they had millions of dollars from overseas, and they wanted to buy up like every house in our neighborhood because we're right near Disneyland.
Mhm.
And I was like, yeah, that you're gonna have to find somebody else, because I can't get behind this, you know, because they're gonna pay a lot of money for the houses, which is great for the sellers, but overall for the general health of things, it's not a real market. It's BS, you know. And so what happened was that a lot of big corporations bought a lot of houses in Anaheim. And I can't remember exactly what year it was, but it was in the teens. And so then all of a sudden, you know, everybody had vacation rentals on their streets. And there were some streets where there were more vacation rentals than there were homeowners. And that is where you can take a free market and you got to take a step back and look at it and say, is this good for everybody, or is this just good for one entity? And you've got to figure out a way to sort of, you know, pace things out, even things out. So you'd look at the vacation rentals and you'd say, well, let's only have, you know, 4 every quarter mile, or I don't know, something like that. They've come to a conclusion now that seems to be working with vacation rentals, but about half of them sold. But that's what I'm saying. When these big, you know, we've got a housing crisis that's been going on forever. And when these big companies get involved, it really is not, it's not sustainable. It's not real. It's very frustrating.
Well, I hear you. And the thing of it is, with these big companies, look at their numbers. They're losing hundreds of millions of dollars. By the way, it's not scalable.
Right.
And it's still a very person-to-person business, as you said. It's not like buying a brick and mortar. Let's go buy a bunch of Home Depots, right?
Right.
It's a different model. And so these companies, these venture capitalists come in and think, well, you know, if you can have a bunch of Home Depots, why can't you have a bunch of people buying houses in the neighborhood? You can't do it. It's not scalable. It messes up the entire ecosystem of the housing market, if you will. Right. It's not a brick and mortar business.
Well, plus, what have they done with all these houses that they bought that they lost money on? I'm pretty sure they probably resold them mostly to other investors, and they're probably rentals. I mean, this is just, and
well, I heard a story where they sold their house to an iBuyer at a high price, and they bought it back from the iBuyer for $100,000 less.
Wow. That's really interesting. They really knew how to work that.
I'll take 5 of those deals.
I know, exactly. I'm like, can't blame them for that, right?
Right.
But there's just things, now that the market is taking, a little bit of it's not taking a break. It's just like things are, looks like, and I'm grateful, quite frankly, because it has been 3 years of just running at 10 miles an hour on this
Right.
real estate treadmill. So I think things are going to be back to maybe a little bit more of a balanced market. I wrote some offers this weekend. One of the houses that was great. It was priced appropriately, and there were 2 offers, and it went for 30,000 over. Our offer was 20,000 over. But we knew it might go 30. Then another one was priced about 100,000 less than market, and so we wrote a real beefy offer on that. But they said, I think the agent said that he had like 7 offers. So 7 offers with 100,000 under market minimum price. I mean, that's, if it was last year, it would have been 47 offers. Yeah. And it would have been 200,000 over that. So I think everybody needs to step back, look at the model that's being used and assess the situation. But now, like I said, that things have taken a little bit of a deep breath. We can look at some of these practices that have been going on, like the iBuyer. I'm pretty sure it started somewhere around 2017, and say, what in the hell did this morph into, and who is keeping an eye on this? I mean, Anaheim, where I'm at, I mean, I sell houses, of course, anywhere within about an hour of where I live. I've been doing this for a long time. I've sold over 1,000 houses everywhere, but Anaheim is obviously where I live, and it's where my heart is. And there are mostly first-time home buyer houses around here, So it's been definitely affected. And it's like, if you've got a home buyer living in a house, and it's a little bit different than if it's an investor in New York City, in a high rise. So
Pretty true. Well,
that's my rant for today.
Well, listen, I hear it, and we've all been in this market for a while, but look, now we're seeing that these companies that went out to Wall Street and raised hundreds of millions of dollars, had this big splash. We're going to change, upset the market. We're going to be the next Amazon of the real estate business, whatever they want to call themselves. And a year or so later, the announcements are, we lost 300 million, we lost 500 million, we're exiting the business.
Yeah.
The model that doesn't work in real estate. It's called
Yeah. We'll just keep doing what we're doing, but we're people persons. So There you go. Well, thanks, Rick. I appreciate your time today. Thanks for listening to me rant and rave, and I will see you next week.
All right. See ya. Take care.